Hi there, thanks for tuning in. Today, we're going to be doing an analysis and valuation of Gestamp Automoción. They're a company that's based in Spain but really worldwide that does automotive engineering and especially works with steel and different auto parts. So, let's get started. So, 2023, they reported recently their final yearly report and they have done amazing. Their revenues are up significantly, their EBITDA is up significantly, and their net profits are up significantly. So, overall, the picture paints very well for them, at least in this year. And it's a year where electric vehicle demand was actually down. So, it bodes well that they did okay and that they outperformed in a year where there was maybe a little bit of disappointment in auto sales. They basically had an unexpected, outstanding market growth, as they say it, and production volumes are up for light vehicles. So that's good, but they also say that 2023 auto production growth beating all estimates, but at two speeds, a strong first half and a softer second half. So that's something to keep in mind. Coming into 2024, the growth may be a lot softer, especially in the developed world. The auto industry may just shrink a little bit, as a matter of fact. They, however, have been consolidating their financial profile, so their revenue growth from 2019 to 2023 is 16%. It's great that they include 2019. That way you can compare from before the pandemic rather than after. Their profitability is better. Their EBITDA margin has improved. Their cash generation seems to be better. Basically, their free cash flow gives them 200 million euros every year or upwards. And their leverage has gone down from 2.5 times net debt to EBITDA to 1.5 times. We love seeing that. They also say that a key lever of their growth is essentially going to be high EV sales. It's going to come from being 14% of their revenues to 20% of their revenues right now in 2023. So, and what they're doing is the stamping and the battery box, which are basically going to be big differentials for all these EVs that they're going to create. Okay, great. Now, their net income has been improving a lot as well. 2020, they obviously had a difficult year, but in 22 and 23, they outperformed 2019 levels, which is wonderful. And what they're saying is it's driven by revenue and EBITDA growth, financial discipline, and this is all despite higher financial costs, but a stronger negative forex impact as well. So it's just important to note. They also paid an interim dividend of 7 cents per share, which is wonderful, and it's aligned with the shareholder remuneration policy. So they have that. If they do very well, they're going to pay you an extra dividend if you're a shareholder, which you love to see. Now, they also are very geographically diversified. We also love to see that, honestly. Look at that. Honestly, no one region takes over a lot of their revenue. We love seeing that. Generally, Asia, Mercosur, Eastern Europe, and Western Europe are the big areas. NAFTA, essentially North America, is where they've been struggling a little bit recently. Especially look at that. Their EBITDA margin went from being 8.4% to 6.7%. That's not great. But everywhere else, they've been pretty much outperforming. And this is wonderful to see. It's also great because no one region will affect their revenue, period. We love geographic diversification. It's important to be diversified in the areas of business that you do. It's important to be diversified maybe in the clients that you supply to, but geographic diversification is not talked about enough, honestly. And I think this shores them up from global economic downturn if it's not as global as one thinks, especially now in a world that's maybe a little more isolationist than the world was 10 years ago, 15 years ago. So, free cash flow generation has seemed to be pretty strong, and what they did with it was decreasing the net debt, minority acquisitions, M&A, and dividends. So they're putting that cash to use. It's fantastic. So this includes investments this year versus capex. So they are essentially saying that their capex is a little higher than reported, which is something to take into account, but this is great. We love seeing them talk about free cash flow. And their balance sheet profile is looking better. Their leverage is coming down. So it went from 3 times debt to EBITDA, now all the way down to 1.5 times. And their target is 1 to 1.5 times, which is great. This means that if they happen to go bankrupt for whatever reason, when they actually liquidate everything, the shareholder will get something. They will see something of value to themselves. Okay? They also have limited market growth in the context of 2024 and onwards, especially the automotive industry in general is going to just see very limited market growth. And that's important to note. 2023 is an amazing year. The picture is going to soften a little bit. They're even saying that the automotive market is going to go down by 0.4%, and then after the CAGR is going to be 1.7% all the way till 2027. Not great, but that's okay. Now, EV will be the main growth driver, where the CAGR is going to be 24.8% all the way to 2027. That's a lot of growth. This last year, they underperformed the growth expectations, but we'll just see what happens. I don't think anyone can actually predict how much EVs are going to grow by. We just know they are undoubtedly going to grow, and the fact that they are preparing themselves to make that a larger portion of their business is fantastic. Another thing, their guidance. So revenue, they're going to outperform the market. So again, these numbers that they're giving us of 1.7%, they're saying we're going to slightly outperform this in the low single digit range. So let's talk about 2 to 3%. The auto business is going to basically stay the same, but they want to improve their EBITDA margin. At least keep it in 2023 levels and improve the margins a little bit. And then the free cash flow generation is going to stay positive, and their leverage is going to be the same, 1 to 1.5 times. Okay, so we have a prediction. Now, I want to make a model. I want to forecast the future. To do that, I'm going to look at the past a little bit. I'm going to compare the revenues and see how much they turn that to free cash flow. Now, the average here is about 3.33% of revenues, at least from 2019 to 2023, get turned to free cash flow. I'm going to be conservative and just call this 3%. So 3% of revenues get turned to free cash flow. Now, let's forecast the future. So with a discounted cash flow model, I'm going to say, you know what? They are going to grow their revenues by 3% from 2024 to 2027, and then 2% in perpetuity. Very conservative number here. And 3% of that number, of those revenues, is going to be turned to free cash flow. And thus, I have these numbers that I'm plugging in here for free cash flow. And then I am going to put this on the discounted cash flow model with a required rate of return of 11%. That's my personal required rate of return. That's 1% more per year than the market in general. Perpetual growth rate of 2%, as we said. And we get a fair value of $7.60 once we divide by the total number of shares out. However, look at that net debt. The net debt is pretty significant, and that we have to subtract, and then we get a fair value of $3.85, 3 euros and 85 cents actually. This model is in euros, and if you're going to do it in dollars, you have to convert it. They also have an ADR that trades in dollars, but you'll just have to convert that. Now, let's compare it to the actual price of the stock right now. Wow. So Gestamp, as you see, has buy points and sell points. Honestly, they've touched this 3 level a couple times. They've gone all the way up to 4, sometimes even 5 since 2021. So if you'll look at this, I'm saying 3.85 is basically the fair value. Right now, it's way below this, and it's touched this point here of 3 where I would have totally bought it. Maybe here at 450, I would have considered selling it, honestly, or at least not bought more. So right now, it could be at a potential buy point. The dividend is basically 5%. The PE ratio is 6, which is incredibly low for a company like this, especially when you see EV companies trading in the 30s. And you have this company that supplies to EV makers that's trading at 6. That's crazy. They have a market cap of 1.68 billion, so they're not huge, but they're not tiny either. But I think this picture is looking interesting at the very least. So all in all, Gestamp is trading like it just had a horrible year, honestly. Look at this. Look at this just bad trend. And they reported a pretty great 2023 with a realistic forecast, and it seems like they got punished for it. And yet, if they can shore up with the profits and advances made this year, they can do well even if tough years. There's 2 competing stories here. One story is Gestamp is going to be doing really well and hopefully slightly outperforming the sector. The other one is the sector is a little bit difficult because EV sales have been slower than forecast, and that means that there may be slightly less manufacturing. So that would hurt Gestamp's business. But if they do the right things this year, if they keep generating cash, if they keep the net debt low, and if they keep paying you a dividend and buying back shares, that may not matter. With the decrease of net debt, the dividend, share repurchases, you're getting value even if the stock stays not growing, even if the company doesn't grow that much in terms of cash. So if they can mildly overperform the growth of the industry, they look like a great long-term investment, but the risks are still there. So, are you ready for the bad years? If you're hopping into stocks like these, are you ready for some years that are honestly going to be pretty awful on paper, but if they make the right decisions, if you trust management and their long-term plan, you may be rewarded in the long term? Are you ready for the bad years with a company like Gestamp? If the answer is yes, then maybe it could fit your personal situation and portfolio. With that said, thank you so much for watching. If you like content like this, don't forget to like and subscribe, and just comment down below anything you want really, but just tell me if you like this video or if there's any stock you want to see. It really helps me with the YouTube algorithm, so I'd appreciate it a lot. Thank you so much, and have a great rest of your day.